Today, I want to talk to you millennials about how to build wealth. Let's say you're making 6, maybe even 7 figures a year in your business. But here's the question no one's asking you. How much of that income are you actually keeping? Not just this year, but 5, 10, 20 years from now. Because the truth is, earning a high income from your business is only step 1. If you don't have a plan to convert that income into long-term tax-efficient wealth, you're just spinning your wheels. And I see it all the time. Business owners pulling in $300,000, $500,000, even $1 million a year, but they're still working around the clock, shouldering all the risk, and not building personal net worth the way they should. Now, don't get me wrong, income is great, but income doesn't equal wealth. Wealth is what you give freedom from. Wealth is what builds that options. Wealth is what creates legacy. So in today's video, we're going to break down why high income without a long-term strategy often leads to burnout or regret. The 4 shifts business owners need to make to turn active income into lasting wealth, and what the wealthy are doing differently to build net worth faster with less tax. Hi, I'm Nathan Seeley, founder of Brass Ring Wealth Management, and I help high-income individuals, families, and business owners reduce taxes, grow their wealth, and plan for lasting financial security. If you find value in this video, be sure to like, comment, and subscribe. It helps more business owners take control of their financial future. Part 1. Income doesn't equal wealth and why that matters. Let's start with the biggest misconception that holds back even the most successful business owners. High income does not automatically create wealth. You could be earning $300,000, $500,000, even $1 million a year, and it still feels like you're not making real financial progress. Why? Because income is what comes in, wealth is what stays. And for most high-income earners, that gap is wider than it should be. Here's how it plays out. You work hard, you grow your revenue, take home more income, but then life happens. Taxes eat up a huge portion right off the top. You reinvest aggressively back into the business because that's what you've been told is smart, and maybe your lifestyle grows alongside your income. Nicer home, private school tuition, maybe a vacation property, all well-earned, but all pulling from the same pot. End of year, you look at your tax return, you see a big number at the top, but your balance sheet hasn't moved much. There's no investment portfolio, no real estate producing income on the side, no long-term compounding happening quietly in the background. In other words, your business is making money, but you aren't building wealth, and that's the trap. Now, don't get me wrong, your business can be one of the best wealth-building tools you'll ever have, but only if you start treating your income as fuel for something bigger, something that isn't just about this year's profit, but about your family's financial security 10, 20, or 30 years from now. This is the shift the wealthy figured out a long time ago. They focus less on how much more they're making and more about what they're keeping, how it's being taxed, and where it's being grown. Because they know that earning $500,000 a year means very little if you're spending $400,000 and paying $150,000 in taxes. Meanwhile, someone earning half that, but with the right structure, can be quietly building a multi-million-dollar portfolio over time. So before we get tactical, this is the first mindset shift. Stop measuring success by income alone. Start measuring it by how much progress you're making toward long-term, tax-efficient, sustainable wealth. That's what unlocks real freedom. Now, how do you actually start making that shift? Let's break it down, starting with one of the biggest drivers of long-term wealth, your tax structure. Part 2. Tax structure is the foundation of wealth. Let's talk strategy, because when it comes to turning income into wealth, your tax structure is everything. Here's the truth most business owners never hear. It's not how much you make, it's how much you get to keep after taxes that makes the real difference. You can be killing it with your top-line revenue, but if all that income is flowing through a tax-inefficient setup, you're leaving tens, even hundreds of thousands on the table every year. So here's the question. Is your business income flowing through the right structure? Let me give you a basic example. Imagine you're making $400,000 a year as a sole proprietor. All that income is taxed at the personal level. Full marginal tax brackets. No corporate planning, no income splitting. Depending on your state, you could be paying 40 to 50% in combined federal and state taxes. Now contrast that with a business owner making the same income, but is using a properly structured S corporation with salary dividend planning, a defined benefit plan, and perhaps even a family management strategy. Suddenly, they're saving $30,000, $60,000, sometimes over $100,000 per year in taxes, legally. And that's not money being spent, that's money being redirected to build wealth, into retirement plans, into tax-efficient investments, into corporate-owned insurance strategies, into real estate or passive income portfolios. That's how the wealthy do it. They build their tax strategy first, then layer the wealth building on top of that. Because here's what they understand. Every dollar you save in taxes is a dollar that can be invested, compounded, and used to build something permanent. Now, is it always simple? No. Is it legal? Absolutely. We're not talking about gimmicks or gray areas. We're talking about proactive, IRS compliant planning that high-income families and business owners have used for decades. So if your current setup looks like this, all income flowing directly to you personally, no strategic salary or dividend mix, no retirement structure built around your corporation, no review of your spouse, kids, or other family members that might be involved, you're likely overpaying and missing major opportunities to build long-term wealth. And it's not just about tax rates. It's also about what you take for income and how you take the income and what account types you use to invest that income. Which brings us to the next key shift, the wealthy myth. Part 3, building income beyond the business. This is where real financial independence begins. Because no matter how successful your business is, one day it won't be your main income source anymore. All of your wealth is tied to one income stream, the business. You're not financially free, you're financially fragile. Here's how the wealthy fix that. They don't just rely on the business for cash flow. They use the business to fund other income producing assets. Let me show you what that looks like. Imagine a business owner earning $500,000 a year. Rather than just drawing it all as salary and spending it, they start setting aside $100,000 a year from retained earnings. Here's what they might do with it. Buy an income property that produces $3,000 a month in positive cash flow. Max out a corporate retirement plan like a solo 401k or defined benefit plan with $50,000 to $100,000 a year. Build a dividend-paying investment portfolio inside a corporate or brokerage account. Use corporate-owned life insurance to grow cash value in a tax-advantaged way. Or even lend money privately through secured lending opportunities. These are the kind of moves that create income even if you stop working in the business. Because think about it, your business is great when it's active, but what happens when you want to step away? Whether you want to sell, retire, or just work less, those income streams outside the business are what give you the freedom to do that. And here's the best part. You don't need to be a multi-millionaire to start. You just need to build a system. Save consistently from business profits, deploy capital into income-generating assets, use tax-efficient accounts and strategies to do it. Let compound growth and diversification work over time. That's what separates the high earners who stay dependent on their businesses from the ones who eventually own their own time. Because the goal isn't just to turn a successful business. The goal is to build a life that doesn't depend upon the business. That's how the wealthy retire early without fear of running out. Now, in the next section, we're going to cover how they protect that wealth once it's built, because growing it is only half the battle. Let's get to that next part. Part 4, protecting the wealth you've built. Here's something most business owners don't realize until it's too late. Growing your wealth is only half the job. The other half is protecting it, because the more you accumulate, the more risk you have. Risk of lawsuits, risk of unnecessary taxes, risk of poor succession planning, and worst of all, the risk that the wealth you built doesn't actually benefit your family the way you hoped it would. So how do the wealthy protect what they built? They do it through structure and strategy. Let me walk you through a few ways. Corporate structure. If you're earning through a corporation, you've already off to a strong start. But wealthy business owners go further by using holding companies or family trusts to hold investments, reduce risk, and plan for the future. Holding companies can insulate retained earnings from business liabilities, and trusts can ensure that your assets are passed on smoothly without probate, without confusion, and without unnecessary tax. Asset protection. That could mean holding your real estate in LLCs or corps to shield personal assets from liability. It could be using insurance, not just for life and disability, but for key person risk or buy-sell agreements with partners. One lawsuit, one accident, one mistake can jeopardize decades of hard work if you're not protected properly. Tax efficiency. The wealthy don't just pay what's owed. They plan ahead to legally minimize what's owed. That includes splitting income with a spouse or adult children, using corporate class funds to reduce taxable investment income, deferring or eliminating capital gains through tools like installment sales, opportunity zones, or charitable trusts. And when they're planning for retirement, they don't just default to the standard retirement savings plan or 401k route. They consider asset location, tax brackets, and withdrawal strategies that maximize after-tax income over a lifetime, not just this year. With estate planning, wealthy business owners understand that what happens after they're gone matters just as much. That's why they take the time to set up a proper estate plan, a living will or trust, a power of attorney, beneficiary designations, and clear instructions for business succession or liquidation. The last thing you want is for your family to get hit with a tax bill or worse, a legal battle, when you're not here to fix it. The point is simple. If you're serious about turning income into lasting wealth, you need to protect it as fiercely as you built it. Now, in the final part, let's bring this all together and talk about how to actually implement it in real life. Because this isn't a journey, it's a system you can build by starting now. Part 5, putting it all together. So let's recap. If you're a high-income business owner, the key to building long-term wealth isn't just about making more money, it's about being intentional with how that money flows. Here's the framework again, step by step. Separate what you earn from what you keep. Use a corporation to control taxes, smooth out income, and reinvest strategically. Turn income into assets. Don't let cash sit idle. Convert earnings into investments, real estate, stock, or business assets that can grow over time. Build your financial infrastructure. Get the right team, a tax pro, a financial advisor who thinks like a business owner, and a legal support for structuring deals the right way. Protect your wealth you built by using insurance, legal structures, and estate planning tools to defend what you've worked so hard to create. And finally, commit to a long game. The biggest wealth builders I work with aren't just smart with money, they're disciplined. They follow the plan even when the headlines change. That's how you build wealth that lasts. Not just for you, but for your family, your legacy, and the most important people. If this hits home and you're serious about building real wealth from your business, here's what I want you to do next. Book a strategy call using the link in the description. We'll take a look at how much income your business is generating, where it's going, what you're doing with it today, and where the biggest opportunities are to reduce tax, invest smarter, and protect it for the future. Whether you're just getting traction or you've already earning multiple 6 or 7 figures, there's always room to improve your structure and take that pressure off your income. And if you haven't already, don't forget to like this video, subscribe to the channel, and drop a comment. Let me know what's your biggest financial question as a business owner. I'm Nathan Seeley, founder of Brass Ring Wealth Management. Thanks for watching, and I'll see you in the next one.